Welcome, everyone. Thanks so much for being here today. I'm excited to share some wonderful financial tips with you and introduce you to some amazing leaders in Montana with lots of wisdom for you today. For those of you who don't know me, my name is Jen Ewell. I am the director of the Women's Foundation of Montana, a statewide nonprofit, part of the Montana Community Foundation, and all about creating a brighter economic future for Montana women and girls. And today we are here because we're all going to learn a little bit about our own personal finances, how we can manage them masterfully. I know this is a hard time for women. You may have seen some of the recent stats and the fact that women are losing jobs at a far greater rate than men right now. And we are just struggling to figure out how we're going to support our families. But I think this information is always timely and always helpful. And at least we can learn about how to manage what we've got. Hopefully learn about increasing savings and investment for the future. To whatever extent we can do that. And really, I think these webinars and this conversation today is really about all of us sharing our wisdom and creating a community of support for each other. And so today, that is all about our financial well-being. And I like to just do a little bit of the housekeeping at the beginning. So these webinars are recorded. We do not record the messaging in the chat box. So it's just the video portion, just so you know, as you think about how you want to communicate in this space. We do encourage you to introduce yourself in the chat box if you would like. For the major portion of our conversation today, most people's mics are going to be muted so that we don't get feedback. But at the end, we are going to have a question and answer session, and you can either put your questions in the chat or you might get called on to kind of voice that too, if you are interested in just asking questions that way. You can unmute yourself at the end and do that. Okay, so with that, we are going to go ahead and get started. I'm going to ask some of our folks who are going to be speaking today to introduce themselves. So Kim Shappee is a financial advisor, former board member of the Women's Foundation, and also on our Dream Team, founder of the Athena Conference and all sorts of wonderful things. And she's going to share a lot of her financial wisdom with us. But this webinar was really the brainchild of our Helena PowerHouse folks. And so they're going to help kind of manage the conversation today and facilitate questions. And so I'd like for them to introduce themselves quickly as well, so you know who is making this possible. Julia, could you introduce yourself, please?
Hello, everyone. Thanks for joining us today. My name is Julia Bryant. I'm the Brand and Project Manager for the Governor's Office of Economic Development and Office of Indian Affairs, and just a super proud member to be within the Powerhouse community. So thank you all.
Thanks. Thank you for making sure this happened, Julia, and for being willing to facilitate today. And then Davy, would you like to introduce yourself?
Hi everyone, I am Davy Madison. I am the program director for the Montana Cooperative Development Center, based out of Helena, and I'm super excited about this conversation because this is one of my favorite topics. Yay!
Yay! And I should add, for those who maybe don't know, Powerhouse Montana is a program of the Women's Foundation, and it is to start an online platform that connects women to resources and mentors across the state. You can find it at powerhousemt.org. But the online platform has also kind of created a bunch of in-person communities across the state that usually get together in person. Now with COVID, of course, we're doing online gatherings as well. So thanks to our Helena Powerhouse women, we're having this webinar today. And then, of course, Kim Shappee. Kim, thank you so much for being here and for being willing to share your wisdom with us. We're so happy to have you.
Thanks. You want me to introduce myself more?
I would love it.
My name's Kim Shappee. I'm born and raised in Missoula, Montana, and that's important to me because I was born and raised by small business owners in the state of Montana. And I grew up with this culture around a point of sale system, and keeping track of your finances and what it was like to really be held accountable for your finances. I then ended up going to Babson College, which is the #1 college in the world for entrepreneurship. And all we did in our first year at Babson was run our own business. And every Friday we suits and we would have to pitch to venture capitalists. And it was really important to us and to Babson that those businesses made money in the first year. After Babson, I went and I taught entrepreneurship at the University of Stellenbosch in South Africa, which was an incredible experience for me. And in South Africa, what I saw was what I think everyone here knows. And I got to work in these townships. And basically when women spend money, they spend it differently. The first thing they spend it on is typically on their family. And the second thing they spend it on is community. And so that time, Babson, South Africa, I then went to South America, did some more research on micro lending. And what I saw is that when women have money, great things happen to the community and to the world. And so I came back to Montana super fired up about closing the pay gap and helping women get seats on corporate boards and in leadership positions so that we could have great change around the world, especially around financial power and the trickle down there. I then ended up starting a bank. And the only reason I bring that up is I have quite a bit of experience in lending and commercial lending and how banking actually works. And after that, I left and I started becoming basically a financial planner and financial advisor. When I was at the bank, I taught these classes. Governor Schweitzer was the governor at the time, and he wrote me some nice letters about the classes, but they were specific to women and money and what happened in the 2008 recession and how people were managing their money. And basically that led for me to become a financial advisor because so many women said, I know I can do it on my own, Kim, but I'd love some help. And can you do that? So now I get to help business owners, women, and executives get really clear on living their best life and their financial dreams, which is the fun part. And then I get to help break it down for them on how they can achieve their goals and actually execute on their goals. Is that enough, Jen?
Yes, I think that's very helpful.
Okay.
So we'd love to hear your presentation.
Okay, you're ready? Great, thanks. I'm going to share my screen. And I'm not the best at this, so please give me a second. And here we go. So I want to call today's time Your Money, Your Power, because what I mentioned earlier, when women have financial power, great things happen. But women, for some reason, shy typically away from the word power. And something that I've observed in working with people for the last 2 decades around finances is instead of people turning into the people they want to be when they talk about money, they often turn into people that they didn't even know they were. It's like this inner child that's kind of afraid and sometimes meek. So just thinking back to the last time you had a conversation with your boss about why you're worth so much and why you need a raise, or about why you deserve a loan from a bank to start your own business, or even with your partner or spouse around finances. If you didn't feel strong and confident and comfortable in that conversation, that is definitely one of our goals from this conversation, is to help you get there. And so a question I want to start with today is, do you have money or does it have you? And are we bookending our days with scarcity? And what I mean by that is even pre-COVID, what I heard a lot was, I didn't get enough sleep. I didn't get enough done. I don't have enough saved. It was constantly like the scarcity mentality. And then I was lucky enough to travel to places where, like South Africa, where they let me into their hut that was essentially made of like a couple pieces of wood and then some scrap metal that they'd found. And it felt like they were so rich and they had so much. And just this reflection on FOMO and comparison being the thief of joy, and where are you today, and sitting in your truth. So that's some like big picture pie in the sky stuff, so we can get down to doing the work. Because I think it's really hard for women, especially, to get excited about things like budgeting and credit scores if you don't have a big vision that you're working towards. And if you also don't reflect on how you're feeling today every time you talk about money. We've got to make it a little bit more fun. So these are some disclosures I have to throw out there around my work. We're going to go through that slide. I've told you a bit about me, and now I'm going to move on to our agenda today. Today, we're going to review measurement and why it's really important in order for you to improve your finances. We're going to review where you are today. Then we're going to talk about some best practices, review where you want to get to, and then I'm going to assign some optional homework if you want to tackle that before our next meeting. I love this quote, and if you haven't read this book, I would add it to your list of personal resources. We don't rise to the level of our goals, we fall to the level of our systems. This is what I see day in, day out with everyone I work with, whether it's in banking or personal finance or investing or business building, right? A business is only as strong as its systems. Simon Sinek has a great book on this. And so what are your financial systems today? Do you have financial systems in place? And I'm going to start with financial review frequency. So this today is like the most important slide for your take-home work. Okay, so I want to start with this gut check question to you is, what is your financial review frequency? Do you review your finances weekly, monthly, semi-annually, annually, or only when you need a loan or you feel like kind of like, oh, I've got some time and I should do this? I think right now, in the middle of a pandemic and a recession that maybe sometimes doesn't feel like a recession, but is in fact a recession, it's super important to review your finances at least monthly. And so this is where we're in the tree of trust, and poor Jen has heard this so many times, but my husband and I meet every month on our finances, and we have an agenda, and it's the same agenda every month. And we talk about, for the most part, the same things, but the numbers and the metrics are different. And one of our bullet items is always our goals and our big picture. What are we working towards? Where are we going? But having that consistent meeting gives us a time to talk about our finances in a structured way that isn't heated. And it also makes us both prepare for the meeting. I've really been reflecting with so many Zoom meetings on what meetings are important right now and what meetings aren't necessary. And if you don't come prepared to a meeting, I mean, it's just kind of, in my opinion, not worth going to the meeting. And so it's super important for me and Ross to have that meeting in our calendar because we know we need to prepare. And Ross is going to do certain things pre-meeting and I'm going to do certain things. So I think this is something you could take away from today is, what would financial review frequency look like for me? Next up is, do you know your credit score today? And I'm going to talk a bit more about credit scores. But if you don't know what your credit score is within the last 3 months, I think there's an opportunity there. Personal net worth today. A lot of people shy away from this and they're not actually even sure what their net worth is. So I'm going to break it down for you right now. Your personal net worth is all of your assets total. Assets are things that you own. So an example here would be your home, your retirement account balances, your checking account balances. Some people own cars that are fancy. Most cars I don't think of as assets, they're liabilities, right? We have to have a car, but for the most part, they're just gonna go away and you always have to renew them. But if you had a fancy car, fancy art, if you have gold hidden somewhere in your home or silver, those are your assets. A business is an asset. When talking about a business, and I'm sure Julia and I will talk about this more later, what we see in Montana is a lot of solopreneurs that build a job for themselves, but not a business of transferable value. I hope you're not mad at me. But I think that's something really important for us to reflect on is your business an asset? Could you sell it? And then when you sell a business someday, there's an asset sale and there's a stock sale. And so the idea is are you selling intangibles like a client list? Or are you selling a bunch of equipment? Like I'm selling excavators and I'm selling brewing giant cistern things. Like what are you selling? So your business, are you building a business that has transferable value? Okay, back to your personal net worth. So you've got your assets and then you take out your liabilities. Liabilities are all of your debts. So credit card balances, mortgages, commercial loans, possibly, student loans, car loans, etc. So look at that. Your assets less your liabilities gives you your total net worth. Some people will do this exercise today and have a negative net worth, right? Especially if you graduated recently, like a doctor that graduated recently probably has hundreds of thousands of dollars of student debt and possibly doesn't have assets built up yet. The best asset that I see out there right now that's undervalued is you. And I'm talking about investing in you and your future earnings. And most people don't see that. And we're impatient, right? We're especially impatient today. And we want it all now. And I want you to remember, depending on your life stage, in your 20s, you learn. And in your 30s and 40s, you start to earn. Okay. So it's super important that you think about, where am I? Because a lot of people in their late 20s want to be somewhere else and they feel like it's too hard to do the 401k and the emergency savings and buy a house. And I want you to remember you're going to go through different life cycles of your finances. So if you don't know your personal net worth today, that could be a homework assignment from here. Current monthly spending. We're going to talk about budget, but most people that I talk to don't actually know what their current monthly spend is. And that's one of the first things that we tackle, because when I do a financial plan for someone, most people want to know, Kim, when can I be financially independent and retire early? When can I stop working and have work be a choice? And for me to do that math for them, I have to know how much they spend today. And I have to know how much they want to spend in the future when they also want to stop working. And I want to tell you about that. Have you ever been driving and you see one of those like remote signs that set up to monitor your speed, your miles per hour. And you're like, whoa, I'm going 45. I thought I was going 26. Like this happens to me at least once every 2 weeks. And I've got my kids in the car and they're like, slow down, mom. Anyway, instant measurement. Do you know what it does? Makes me slow down, right? But if you're never checking your spending, and if you don't check in on where you're going, it's really easy in the day of the credit card and the day of the Venmo and the day of the instant swipe to have no idea where your spending's at. I also want to throw a stat that I read about that. Let me see, I wrote it down. Yes, people, this one's so true. We underestimate how much we eat and we overestimate how much we exercise. So if people were trying to get 10,000 steps a day, that's somewhere between 4 and 5 miles. And most people think that they walk 4 miles a day, when in fact, they're actually getting close to 4,000 steps a day, which is closer to 2 miles. So just, we tend to underestimate in terms of our spending and overestimate in terms of other areas of our life, like our ability to save and our capacity. So I want you to know your current monthly spending always. Like Ross and I right now could tell you where we're at as of October 22nd, how much we've spent. And I could say that we're at 60% of our monthly target or 70%. And I could say, and because we're where we're at, we decided we can't afford that couch that we've been wanting because we've been cutting back, or like, whoa, we need to slow down and we're not going to eat out, or we're not going to take that trip we wanted to take in November. Sorry about my light, everybody. I can't control it. Anyway, thanks. Okay, target monthly spending. You need to know where you're at today to know where you want to be. So do you need to slow your roll and cut it back by 10%, 15%? Could you increase it? Very rarely do I see people that are like, I can spend more. They say, okay, I can save more, but you need to know where you are today and where you want to get to. And then current interest rate on debt. So back to that personal balance sheet, can you go back and can you say, okay, every debt I have, I know the interest rate. My student loans are at 2.5% and that's fixed. So I'm not worried about paying them off. Or my student loans are at 8% variable and I better pay them off. Or my home mortgage is at 4% right now. Kim, should I refinance in this world when interest rates are so low? Probably. Let's talk about that. So you need to know the current interest rate on your debt. If you don't, that's a quick, easy, actionable solution that after today you could feel really good about. Emergency savings account balance. So my goal in working with every one of my clients is that at the end of like a year of working together, they have a document that is basically their investment policy and all of their family rules on how they manage their money. And one of the first family rules items you should have, and this is in every agenda for me and Ross, is we always know what our target emergency savings balance is. And if we're there, and if we're over, if we're under. If we're under, we're going to work to get to our emergency savings balance. If we're over, that means we have cash that we could put somewhere else and invest. So before 2008, most people thought 3 months was enough in an emergency savings account. 2008 to 2013 taught us that you should in fact have closer to 9 to 12 months of your monthly current spending or cash on hand saved in an account that is not invested in anything that could go up or down, so that if something happened that you don't expect, so like what are your blind spots right now? So often it's disability or the loss of a job or a huge family emergency or shadow pandemic. What's happening? Women are leaving their work so they can be teachers right now, right? I've thought about it multiple times, like, oh my gosh, how can I do this and teach my kids every day? And or women are leaving their work to caretake an elderly family member or someone else in their family. So women are, this shadow pandemic and the gender equity situation, women are so much more responsible for caretaking in the United States. It's one of the biggest problems, in my opinion, in our country and globally. And it's like, once we solve that, a lot will be better. But so you need to figure out your emergency savings account rule so that if something happened to you, you would have runway or freedom, or I like to say a lever that you could pull in that space. Okay, we're going to keep going and we're going to talk a little bit more about budgeting. People love to talk about budgeting. And most people don't know how to do it. They like know where they're at, but then they don't know where to change. So I'm going to teach you about the 50-30-20 rule, and I'm going to read you one of my favorite lines. So if you want a clear picture of your priorities in life, who you are and what you care about, take a look at your checkbook and your credit card statement. Do you want me to say it again? Because it's that good. Okay, well, if you want a clear picture of your priorities in life, who you are and what you care about, take a look at your checkbook and your credit card statement. So where is your money going and does it align with your values? So the assignment from today, future homework, could be, I need to do a September audit of my spending. And you could pick 1 or 2 categories. Ross and I often pick groceries because it's easy. And then like, how much do we spend on childcare and kids? And then discretionary is always fascinating. So was I shopping too much? Did I spend stuff on home goods? Did I travel and was that extra? So you need to break it down. And before we can even get to the 50-30-20, you need to know where you are. Okay, so do an audit, and there are a couple ways to do that, and we'll talk about that, and maybe Julia can ask me some questions because I'm sure I'm missing something, and usually this is more interactive, so thanks everybody for just going with this. But the 50-30-20 rule was devised by Elizabeth Warren. You've probably heard of her politically these days, but prior to her current politics, she was a bankruptcy professor at Harvard. And at Harvard, she taught this rule, and that meant that 50% of your monthly income should be spent on needs, 30% should be spent on wants, and 20% should be spent on savings and debt repayment. So needs are things, in my family, for example, childcare, groceries, our mortgage, making sure we have a car to get to and from places in winter in Montana, and probably like snow tires. Just thinking about some things that I know people are like, is that a need? Is that a want? Right? Safety, health insurance. If you're a solopreneur and you are shopping on the exchange, that's probably a huge line item for you. But thinking about health insurance and healthcare. Needs, wants. Wants are things that are fun. This is going out right now. I don't know what that looks like, honestly, but you know what I mean, back in the day. So going out, going to concerts, going to, the movies. This is fun things like technology. So many people that I see right now really want the next iPhone. They want a new iPad. Those things. Are those wants or are those needs? And then also savings and debt repayment, 20%. Let's talk about this. Savings is, okay, I'm going to put money in my 401k every month. I'm going to put money in an IRA. I'm going to put money in my emergency savings account for the future because I'm not yet to my rule that I set, which was X dollars. I know that to get there, I need to triage and put a little bit there each month. Debt repayment, this isn't the minimum, right? The minimum is what I'm talking about in needs. So if you're repaying a student loan and your monthly payment is $412, that's the need. But say you want to pay your student loan off a little bit early, you pay $500 a month, that extra $78 or whatever that number was, that is the number that goes into that 20%. Something interesting is that in America, do you know what the savings rate is? The personal savings rate of individuals. Okay, it's something like 1 to 3%. And in China, I believe it's 40 to 50%. A lot of people are really interested in China right now and why some people are saying they're doing better than America, and like many reasons in terms of COVID management, and their GDP is actually going to be positive this year, and their culture is so different, right? So I don't want to like go too much into China and culture, but their savings culture is incredible. Those people are savers and they live within their means. And I think there's a lot to be gleaned from that. And I would love, for you to take the lesson of like, wow, other people do it. We could do it too. And those people in America are often categorized as people who want financial independence to retire early. That's called FIRE. So 20% would be a very good goal in America right now, considering the average is 1 to 3%. So maybe this is, I'm paying down my student loan. I want to pay off my mortgage early. I got a car and I want to pay it off. And it's also, what if I just saved 20% of my income? That's the 50-30-20 rule. For people who have cyclical income, say like a real estate broker, for example, or a business person who like closes deals and gets paid in chunks, this is kind of harder to do, but you can look at it based on the year or quarter rather than the month. And I'd say you've got to give it some time. It's not going to be an easy thing to start on, but it's a great way to gut check, like, ooh, is my spending out of line? Okay. I'm checking our time. Oh my gosh, we're getting close. So credit scores. There are 3 credit bureaus in the United States: Equifax, Experian, and TransUnion. Why are there 3, you ask? Or maybe you don't ask, but I want you to know that it's really important that no one company would have a monopoly on basically ruining your credit life. And ruining your credit life can be serious. I've worked with a lot of people whose credit lives have been ruined, and they're not able to get a loan. They're not able to grow their business. Some of them can't get into the country of Canada, all because of a poor credit situation that shows up by one of these or all 3 of these companies. So each of the companies is there so that no one has a monopoly and can balance it out and fact check, is this stuff actually happening? And your credit history is what someone has done for a long time when they consider, should I lend this person money? They're looking at, have they consistently repaid? How much do they have out that's available on credit lines? Do I think they'll pay me back? And what's the likelihood that they'll pay me back? Okay, so Experian, Equifax, TransUnion. There is one way for you to get a free credit report from each of those companies every year. There's only one way. It's annualcreditreport.com. And the Consumer Finance Protection Bureau, CFPB, made sure that was something that you could get after the 2008 to 2013 recession. So really important that you know annualcreditreport.com is the only place to go to get a free report. Getting a report does not get you your score. Okay. So I would recommend you pay an extra $5 and you get your score, because your score is how an insurance company or a lender is going to quickly assess, is this person creditworthy and what interest rate do they get? So if you go to refinance right now, you want a credit score above 750 to get the most premium interest rate. And if your credit score isn't above 750, we should work to get you there. And that could be one of your goals. So credit scoring is kind of a game system that if you know how it works, you can do better on. And most people don't know how it works. So I'm going to break it down for you really quick. Okay. So on this slide, you can see 35% of your score is based on your payment history. This means since day one of whenever you first had a loan in history, did you pay on time? And there's 30 days late, 60 days late, 90 days late. And after that, they're like, oh goodness, they're really being naughty. Okay. So you want to make sure you never have any late payments. And I know that life happens and maybe you have had late payments, and we can talk about how to work on repairing your credit, but your goal should be to never have a late payment. And in 2020, you can set up automatic minimum payments so that you're never late. This isn't like, oh, I didn't get the bill in the mail and I wasn't able to mail in the check. Today, you should make sure that that's not an issue. This also goes with like electric companies. They could report you to collections. So it's not just credit card bills or home mortgages, etc. 35%, that's the most important piece. 30% is amounts owed. So this is where there's a game. So I always accept a credit increase request, right? I'm like, yep, let's go Amex, $50,000 credit limit. Why not? And I'll tell you why I do it. Not because I need that credit or because I ever want to use it. It's because I know that each time my limit goes up, my ratio goes down. So if I have a $2,500 monthly balance and a $10,000 credit limit, that debt to credit ratio is 25%. But if I have a $50,000 credit limit, that debt to credit ratio, this is the ratio they're talking about in amounts owed, is much lower. And you want this to always be below 25% to have the most premium credit score. And so if you pull your credit right now and it says debt to credit ratio too high, you're now going to know what I'm talking about. And so 30% of your score is negatively being impacted by that. Length of credit history. So we should talk sometime about children and how you can pass on good credit to them. But when I went to college, I had no credit and I needed student loans to go to my fancy school because I came from Montana, and my parents were like, you're also going to pay for this. So, you know, every time you skip a class, it's actually $400. So in doing that, I had no credit. And so I had to start to establish my credit. So we should think about, do I have 5 years of credit history, 10 years of credit history? I work with women in their 50s and 60s who have zero credit because they've never had a credit card and they think it's bad. And I respect that. But I also say, we're going to establish credit for you so that if something happens in your life, you have a credit report and you have a credit history and a good score so you can access that. You can also then typically pass a good credit score onto your children by getting a credit card and getting it in their name that you're a co-borrower on. And I wouldn't recommend doing that usually until like 13 or 14. But that would mean that by the time they're 18, 19, 20, possibly leaving the nest, they could have an established credit history. So length of credit history. It's also a reason that I don't close out my oldest card. I very rarely use that card that used to be from Fleet Bank in Boston when I was in college, but I still keep it. And I try to use it once a year. And I'm like super methodical because if I don't use it once a year, they might close it on me, right? Because I'm a liability to run up money. It's so hard not seeing you. I hope this is helpful. Okay. New credit. New credit is, oh my gosh, they're buying a new car, they got a new student loan, and they're buying a house. What are these people doing? This seems like a lot. Okay. So if you were assessing, should I lend Kim Shappee money? You'd like look at my life and be like, wow, looks like she's kind of spending a lot of money. What's going on? Does she know that something's going to happen where she won't be able to spend money in the future? Why does she need so much? So you should be very careful about, if I know I'm refinancing my house in 2020 or 2021, I should not buy a new car right beforehand. I should not take out another credit card when I'm shopping online at J.Crew or Macy's or whatever it is. You know, you should really limit your new credit. And then types of credit used. So you want one retail credit card, you want one regular credit card. Ideally, you have a student loan or a car loan, and then another loan, for instance, like a mortgage. So that's called number of trade lines, but they want a diverse mix of credit. Never have more than one retail credit card. That is a mistake, and it's going to negatively impact your credit. Okay, moving on. Resources. So one of my favorite resources is mint.com. And Mint basically has the power of aggregating your finances for you if you feel inclined to share your passwords. So it'll take your local bank in Montana, it'll take your national bank, it'll take all your credit card companies and your Venmo and combine them into one. Because when people do their budget in their head, they say, oh, well, I only did that on my credit card. And oh, that came out of our joint account. Oh, that was my personal individual spending. So it's really hard for them to get a good solid picture of their actual aggregated spending. And that's the most powerful way for you to slow your roll and or get in control of your spending. So I love Mint. I use it. I think the security is great, and I'm not super worried about that. That being said, it's not perfect. And there are ways that you could maybe want to tailor it to yourself. So you can always go with QuickBooks and say, I'm just going to do this the old-fashioned way. I'm going to import into QuickBooks. You could hire a personal bookkeeper who can help you aggregate, but like knowledge is power here. So really want you to have the access. So I like Mint, there's QuickBooks, and then Acorns, and let me see the other app that I really like that I just wrote down, Digit. So Acorns and Digit would help you automatically save. So if you're not already doing investing, if you kind of want to get started, it's going to look at your saving, spending habits and your income in your bank account, and it's going to send you prompts that say, hey, it's been 2 days. Looks like you didn't go get that mocha. How about we put $10 in this account? And by the end of a month, you probably would have saved an extra $100. And right now it has saved for its users, this is Digit, $1 billion. So that's pretty impressive, you know? So it's all about figuring out how to work with you than against you. The other thing I advocate for people doing once you do your 50, 30, 20 budget is to just automatically set up those deposits where it's like, okay, I'm putting this much money into my IRA each month, this much into my 401k, this much into my emergency savings. So you don't actually see the money in your checking account until you've already hit your 20% savings goals. Another resource, like I couldn't suggest this more, is go to a local independent bookstore or a Barnes & Noble or subscribe online. It's $10 a year, a Kiplinger's magazine, a Money magazine, or a Forbes. This is where you learn from osmosis. And I subscribe to these publications and then I share them with my neighbors because I'm like, okay, I read it. I'm going to pass it on. We're just going to kind of share this. You could form a women's club where you share these magazines, but reading this like once or twice a year, you are going to get so much good knowledge from it. And it's a fun read. Like I'm like Bubble Bath, Kiplinger's. Amazing. Think about it for your dream evening this winter during COVID. Okay, and then Barron's is a financial publication that the Wall Street Journal puts out, and it's really good. So these are just some of my favorite resources that you could use and access as you work to manage your finances. So I love this picture and I love this story. So Alice in Wonderland is walking and she comes up to the Cheshire Cat and she says, Cheshire Cat, which way ought I walk from here? And he says, that depends a good deal on where you want to get to. And she says, it doesn't matter which way it doesn't matter where I get to. And he replies, it doesn't matter which way you walk. So I want you to think today about where you want to walk. And the most satisfying choice is like, where do I want to be by the end of the year versus where you are today, right? So we did our audit 5 slides earlier, your snapshot, where you are today, your current credit score, your net worth, your financial review frequency, your budgeting systems. And maybe you're like, I don't even have those things in place. So maybe where you want to be by the end of 2020 is you want to know your credit and you want to know your personal net worth, you know. Think of these things, but come up with a couple goals here for by year end 2020, by June 1, 2021, so 9 months out, and by year end 2025. So that's a bigger one. And that might be, I want to own an investment property. I want my business to have revenue in excess of $1 million. I want to have hired 6 people. And to do that, I need to spend time on this and not that. But if you get clear here, it's going to be way more fun to do the other steps and to start to take action. So possible homework, we just touched on it. And now I really want to talk to you about what we're going to do next time. So this downturn and this interesting economy that we're in, and I don't know if our next session, I think it's after the election, so it'll be particularly interesting. It's negatively impacting women in a different way. And I see people make a lot of mistakes during a downturn. And I see a lot of those mistakes in the way they invest and the way they save and also the way they manage their businesses. So next time we're going to talk about that. We're also going to talk about retirement saving and investing and just break down some of the terminology there so you could have a clear path for like, what should my next steps be? And then I know Jen and Julia want to make sure we talk about shopping for life insurance, home insurance, bundling your insurance, and possibly homes, but we might get into that in just a second. So I'm going to stop here and let Julia take over. And I can even stop sharing my screen.
Thank you so much, Kim. I'm just going to echo what's happening in our chat box right now with everyone saying how informative this was. I mean, what, 30 minutes? I feel like I was taking notes madly and we had already talked out what you were going to talk about. So thank you so much. And let's just dive into some questions. So I'm going to start with one that I saw in the chat box as well that I'm just going to add to. So can you go over the emergency savings rule again? And also just add to, if you already have credit cards, how should you be paying off those credit cards first before putting money aside, or should you be doing both at the same time?
Okay, let's tackle that. So I'm gonna start with the credit card question. Most people probably know the name Warren Buffett and Charlie Munger, and they're incredible financial managers. And even Warren Buffett probably can't beat the interest rate that you're being charged on a credit card. So paying off credit card debt is probably one of the most important priorities. But what I see in my work is the importance of success momentum. And so, you know, Dave Ramsey, not my favorite, but has some good stuff on how to pay down debt quickly. But he's got certain methods. I think it's more fun and rewarding to triage. And by that, I mean, okay, I have $400 a month that I could put towards these things. I'm going to put $200 towards my credit card debt. I'm going to put $100 in an emergency savings account and $100 in my future self savings, because that feels like you're building your success flywheel better than it does to put it all towards your credit card debt. So part of it is knowing yourself, right? And like knowing what's going to make you feel better. Cause I want you to love what you're doing so much that you're going to get that like endorphin hit of I'm going to do it again. This feels rewarding. This feels good. So you kind of have to figure that out. And then I'm going to go to emergency savings. So you need to look at your current monthly spend and then figure out, okay, if I lost my job, if I became disabled, am I going to be going to concerts in the same way? Am I going to be spending on as many clothes as I spend? Am I going to be buying the new couches? No, probably not. But what are the nuts and bolts of my monthly spending? And a lot of people, especially women, when they think if I lose my job, I won't have to pay for childcare. And I'm like, whoa, whoa, whoa. You got to include childcare because you're going to need to find a new job. You're going to need to keep your sanity. You're going to need to keep up on your continuing education. So please don't take the childcare out of that factor unless that's, you know, I'm losing my job because I want to stay at home. So you need to take childcare, mortgage, groceries, healthcare, and multiply that by, in my opinion, at least 6, maybe 9, maybe 12. One more point is a lot of people have family backstops and a lot of people don't, right? And I'm just going to touch on the inheritance gap a little bit. A white woman in the United States will inherit on average $141,000 in their lifetime. A Black woman in the United States will inherit $0. And possibly, in fact, like my Black counterpart in New York City is most likely sending money home to her family on top of her earnings, right? So she's like helping support family at home. And this is data, so I'm not making this up. So thinking about your family, and do you have a family backstop or not? Because some people tell me, Kim, I don't need to save for that. My parents would help or I would move in. And other people are like my single mom, dear friends who are like, I am the buck stops here. You know, so how do I shore up my family's finances?
Which, I mean, this kind of leads into another topic around paying off debt versus savings. The idea of, like, for instance, you're planning for a vacation. I think all of us are there. We're dreaming of our vacations, right? Eventually, post-COVID vacations. So you want to save for a vacation. What makes most financial sense? Do you put money into a pot for your vacation, or do you pay off pre-existing debt to essentially reuse that credit card? We've all been there, right? So what's really the best option?
I mean, I think this is part of that question on looking at your values in your checkbook. And, you know, vacations this year, I've been amazed at how some people have been able to save a lot because they haven't traveled jet setting the way they did before. And like even my husband and I, we camped a lot. Like camping, I'm like, oh my gosh, this was so good and felt really great for our balance sheet and our checkbook. So just kind of reflecting on what are different ways to save and still have a vacation. And then also, I think the triage, you know, how do I make paying down my credit card important and feel really good while also being able to have a little bit of fun, because this is my one wild and precious life. And again, money's meant to serve you, not the other way around. Is that helpful, Julia?
Yeah, I think so. Does everyone else feel like that was helpful? I'm going to jump into some of your tips and tricks on how to save in your budget. You brought that up at the end of the workshop, and we all definitely want to know what life hacks you have for us.
So I think one of the first ones is reflecting on if you have car insurance, if you have home insurance, if you have an umbrella policy, if you have any art or boat insurance or RV insurance as someone who lives possibly in the Northwest, can you bundle them all in one service provider? And typically by bundling. So instead of having car insurance at Geico and home insurance at Farmers and something else at Progressive, you call 3 different agencies. And I would definitely call one person local to your community, because isn't that kind of great with the world right now and keeping it local, and ask to shop all of them together. And then the other thing, and we'll talk about this in our next session, is reviewing your coverage. And there's a certain amount of coverage that you need required by each state and nationally. And I think what I recommend recommend is typically 100, 300, 100, but it's $100,000 of personal liability, 300,000 of like entire accident liability, and then $100,000 of like damage to a vehicle or to something in that situation. This is related to car insurance, but a lot of people are overinsured or significantly underinsured there. And so you kind of need to look at your entire life situation and what would happen. And then you really need to shop all those things. So try to bundle and then shop. And we shop, me and my husband shop every 3 years, even though we like our person. I'm like, okay. And every time I save us $500, and then I tell our person, you can either match this or I'm going to go probably somewhere else because this just doesn't make sense for the exact same coverage. So that's one way to save money. Same with cell phone bills. And so many people are paying for a lot of data, and especially for their families and their children. My cell phone bill is $50 a month, and I'm on a business plan, and I like never have to add, you know, data service or more for roaming, et cetera. And I'm not very good at this technology stuff, so I'm sorry to like overly simplify there. But my point is thinking about like, if I have a company and I have a family, is there a way for me to put this all together on a business plan? And if I do consulting on the side, should I call Verizon or AT&T or whomever my provider is about something like that? And just think about, you know, how you can do that there. So that those are two of the best ways that I've seen. And then also having a family conversation. Like if you have teenagers, if you are sharing finances, looking at, once you've done your spending audit, saying, okay, this is the number 4 and number 5 item. What is reasonable here? And how, you know, I'm amazed at the idea kids come up with how to save for the family, and that they're totally willing and excited to be engaged in the process and make some changes. So I think that's another really good way to ask. And I'm going to have to think on this more for next time. I'll think on it.
That's great. How about if you have too many credit cards? You know, we're always trying to raise our credit score. What do you do when you have too many credit cards?
Yeah, you got to decide which ones to get rid of. And then you got to cut them up and call and cancel them. And so I would typically look, so what are my best interest rates? You never want to pay, you always want it to be calculated on the average daily balance. And some of them are calculated twice, which is just like a wrong thing. So make sure that your interest rate is based on the average daily balance. And then for my credit cards, I'm always amazed at like one that's at 13% and one that's at 16. And, you know, obviously you keep the one that's at 13, you get rid of the 16. I also think going back to saving money is calling and saying, can you lower my interest rate by 2 basis points? And 2 basis points in my world is 2%. And that's just like a great practice in rejection. And I was featured in an interview in the last 5 years where they asked me what my favorite advice for young people is, and it's to practice rejection. It's to get rejected like as many times as you can. I love, and I don't want to like, I really, especially in the time of COVID, I'm maybe not doing it as much with a barista, but to just ask for like an absurd price and just sort of practice rejection. Because if you're good at practicing rejection, you'll have bounce. And bounce is what Daniel Pink talks about, is so important to continuing to have like drive in your life. It's to being able to get back up and say, oh my gosh, what happened when the barista said he wouldn't give me a $3 matcha and instead I had to stick with $4.25. Like you should have seen his face pre-COVID when he was like, are you seriously asking? I was like, yeah, just wanted to ask, figured you couldn't, but just thought I'd try. But you know, that's the same thing when you call the credit card company. That you're going to be more resilient and you're going to be able to ask for things. Same with if you ever had a 30 or 60 or 90 day late, calling and saying, would you remove that? Would you make sure not to report that to my to my credit bureau company? And a lot of times they will. They'll say, thank you so much for calling. I will not do that. I mean, you have to call on day 35 or 40, you know, not day 70, but.
So it's being proactive, right?
Yeah, get rid of the credit card. Like pick one to stick with.
So when you cancel your credit card though, does that have implications on your credit score?
Because your amount of available credit goes down and your number of lines. So, you know, maybe don't do that right before refinancing, but if like, so the other thing we should all be doing is freezing our credit. So Equifax had that awful identity breach where 50% of Americans, so half of the people on this call had their identity stolen, their social security numbers, et cetera. And what happens with financial hacking is they wait 2 years before they start to use your social security number. So you're probably seeing this right now that people are claiming social security benefits and unemployment benefits for people right now as partially part of the COVID recession, but it's also 2 years post Equifax, your identity was maybe stolen and you haven't stayed on top of it. So we always, me and my husband and all my clients have their credit frozen unless they know that they're gonna need their credit pulled in the near future. But if you freeze your credit, it means no one can obtain new credit in your name and no one can pull your credit without you authorizing it. So that I think is a really good step. And so I would see it as like, okay, I am going to build my house on a rock. And so to do that financially, if I could start zero-based budgeting style, so from scratch, what credit card do I want to keep? And I know I don't need like any more debt or any loans in the next 6 months. I'm going to cut up these 3. I'm going to be super intentional with my Amex or my Chase or whatever the one that you like is, and then go from there.
Yeah, I think that makes a lot of sense. It's always hard, but so don't do it before refinance, but definitely move towards getting rid of your credit cards and moving towards the lowest interest rates. How about, so we talked a little bit about refinance, which brings me to a question around buying a house. There's been a lot of advice, especially that's been passed down generationally, around how to buy a house, that you need to save 20% before buying a house. But now we live in an age where we have super low interest rates. You know, we're faced with a totally different perspective on buying a home. So can you kind of can you clarify that for us a little further on really where you want to go? Do you want to gain equity with your house and come in at a lower, or put a lower amount down, or should you save and then put that down on a house? What's the best option?
Yeah. So I think there's a lot that goes into play here. And I feel like home ownership being the American dream is sort of this lie that we're all fed. And it's this narrative, sort of like saying it's been passed on generationally. And so 2008 to 2013, when there was this big housing crisis in many parts of the United States, there was a lot of discussion around like, is renting actually better than owning? And what are the numbers there? And there were markets like Houston and many places in Texas where if you'd owned for 30 years, you would be underwater still. Whereas San Francisco, if you bought in the 70s, 80s, 90s, early 2000s, like the, appreciation just kept going up. So there's a lot of disparity there. And then there's also, I think, this confusion around America is really unique in that we have a 30-year fixed mortgage. And I want everyone here to know what that is. And that's the idea that you can get an interest rate of today around 2.75%, which is less than the Fortune 100 companies in America can get on their debt, right? So like Apple, Johnson & Johnson, Pfizer, Google, that's maybe the interest rate they're getting, and they have billions of dollars in the bank. So you can get a rate of 2.75% and it's fixed for 30 years. It will not change. But I would bet you a decent sum of money that in the next 30 years, interest rates will go up quite a bit. And so as a banker, it's important to think about that bank somewhere is going to be upside down on that note someday. So if interest rates go up someday, there's inflation, hopefully interest rates go up so we can like reward savers, but say they're back to an 8% or a 9% or a 7%, those banks are going to wish that they had loans at 8 and 9 and 7% rather than at 2.75, right? And so Canada does not offer a 30-year fixed mortgage. They give you a 5-year mortgage. And that makes homeownership really more challenging because your interest rate can go up and down, which means your payments can change so much. And this is like big picture stuff, but Canada doesn't have any lower homeownership rate than the United States, which I just think is really fascinating and is a fun thing to know about mortgages. So all that being said, do you need to save 20% down? I think the way I see people lose wealth in their lifetime, and I get to see people who have made a lot of money and done well, and then I see people who make mistakes, is they churn on these houses. And I really would question that I can help people manage their money, but it's your time and your life energy that I can't give you more of. And often if I'm doing my job well, I can help with that. But so time and life energy. So thinking about how long am I going to be in this home? Like, do I really want to live here? So I would really discourage most people from flipping or like trying to buy a home for 2 years. So you need to get honest with yourself. Am I going to be in this home for a certain number of years? Because there's so many closing costs to buy a home. And when I did my 4-week class, we spent a whole session on like, let's review that title estimate for you. And you've got title insurance and appraisal costs and lender origination fees and points. So buying a home, I would at least think in your mind that say you're buying a $300,000 home, you're probably going to pay at least 2 to 3% in just general fees to bankers and title companies. So $6,000 to $9,000 probably. That's just like you're never going to get back. So FHA, the Federal Housing Authority, has a great lending program. USDA has a rural lending program. In a lot of places in Montana and Idaho and Wyoming, you can buy really cool homes with much less down. And then there are first-time home buyers programs where all you need is sometimes 0%, but anywhere from 0 to 5% down. So I think those things make sense if you're going to stay in the home for more than 2 years and if you can easily afford the payments. in general, I think it's a great exercise to try and save 20% down, but I also think it's a lie that in America that's how most people got into their home. That is not today, when homes are so much more expensive than they were in the 50s, 60s, 70s, how most people get into their homes. Julia, am I answering your question?
Yes, you are. Yep. I think this is great. I think we're going to pivot now to our chat box. We've got quite a few questions coming in. So I'm just going to call on you and just unmute yourself and go ahead and ask your question.
Historical perspective, 10 years ago, 12 years ago, you would have been earning 5 to 8% in a savings account. And that would have been like really reasonable. And retirees could have clipped that coupon, is what people would say. And they would have just like made the money off of that. So money market accounts are very similar to savings accounts. The deal with the money market account is you can't have more than 6 transactions a month. I don't think right now in America, you're going to earn much more interest in a money market account than you are in a savings account or a checking account. Some of my favorite resources for high interest savings have been Ally Bank or Emigrant Direct or American Express High Yield Savings. Those are the 3 that I use and that my clients use typically, but I 100% hear you. But here's the problem. So February 28th, 29th, because this was a leap year. Yeah, okay. The stock market was at like a record high. We were doing so great, even though we kind of knew this COVID thing was happening. And then the end of March 23rd, I believe, was the low. And so if you had put your money in dividend stocks that month and said, okay, I just like need to earn a little bit more, or even in bonds, let's put it in there, your say $50,000 in savings probably would have gone down to $35,000 by the end of March. And that might have also been the exact same time that you lost your job or that you got sick with COVID and then had all these medical bills. So the whole point of an emergency savings account is to never have the principal be at risk. And that's really, really hard. And so I think that, the questions then are, do I have family support and savings? People right now keep asking me, Kim, why is the stock market doing so well when like macroeconomically it doesn't look great? A lot of like unemployment, a lot of bad stuff. And it's partially that there's nowhere to put money. So I don't know if this makes sense to you, but a person who's retired who would usually be getting 4% in a savings account, right now they're not getting anything in a savings account. So they have to go to the stock market. And there they're going to dividend paying stocks that have been around longer that hopefully aren't as volatile, up and down, up and down. Anyway, tough question. Sorry. I don't really have a better answer for you. Buying a house, is it an asset? I mean, if you're spending money every month on rent and you could, in the same market that you live in, buy and then hopefully have an appreciating asset. And by appreciating, I would say that in Missoula, Montana right now, Bozeman, Montana, Whitefish, Montana, a lot of, Zoom towns is what's happening with COVID, then I think you would see an appreciation that it's a forced automatic savings plan while you're living somewhere. The other thing about a home that I see, especially with women and kids and families, is that it's like so much more than just a place to live, right? It's like roots and an incredible experience and a place you can make changes to. So I think you have to get really clear on like, what is the value of a home to you? And what is home? I would say more people now than ever are being nomads, right? Because if you can work more remotely, then you could nomad and travel, and maybe you don't want to be tied down, because what I see too is stuff owns you. And the maintenance of a home is what people don't anticipate in the costs, and they're very, very real. We have like a large yard, and I had always seen it on loan committees, but like the lenders don't take into account how much it is to maintain a yard, right? And like how much it is to maintain a home, and that something's going to go wrong with a boiler or a roof. So whenever someone buys a home or buys an investment property, I always suggest they have an R&R account, which is repair and reserve. And so my husband and I automatically save money every month into our home savings account, which is just for repairing and replacing things in our home. So just going to throw that out there in terms of, is that a good way to go and a good investment? Let me see, stock market versus homes. Diversification has always been a really important financial rule. And I think that if people really understood the market and the returns over the last 120 years, you would see that on average each year it's 7 to 9%. And so next class we'll talk about, if you had started with $100 in the stock market in 1920, and then today, where would it be without you adding more? The compounding of growth without you having to show up and manage a company because that's what it is. And we'll break that down more, but it's so cool that you don't have to start that company and show up at Apple every day and take the risks of designing the new iPhone and then deploying it to the world, right? You just get to buy some of that stock and then earn either a dividend, so some of the income there, or the appreciation of the stock. That's really unique and special. And so I think, you know, that's a great way for wealth to be created. And since people don't have pensions in America anymore, at least most people don't, I'd say 10% of the population does. You have to figure out, how am I going to reach my goals? Because Social Security probably isn't going to be enough to get you there because people are living so much longer. So I think Julia and Davey and Jen and I should definitely like hold more space for this in the next subject, because wanting to be respectful of time. This is like a big topic. Okay, what did I miss?
Oh my gosh, you got so much information into such a short period of time. That was amazing.
You're so sweet, Jen.
It really was. Real quick, why don't we answer Davey's question, just because it seems like an...
Okay, but we're totally out of time, so it has to be like 30 seconds.
Yeah, I think so. Davey, do you want to just ask it really quick, or do you want me to just read it? Oh, there you are. Perfect.
You can just read it. I was just, so at the very beginning, you talked just about leadership development. And so when I think about it, so would you classify like leadership and personal development, professional development as a need or a want for women?
Yeah, I mean, I think it's definitely a need, but then there's the spectrum, right? And as I look at what I've invested in myself in the last year and like hitting a budget, you know, I think like, you know, you could go big on that or you could go moderate, but I think it's a need, especially if your company's not doing it.
Mm-hmm.
Fun question.
Okay.
Thank you so much.
Thanks, everybody. Appreciate it.
So many good questions. I love it. Thank you for everybody who showed up today. Thank you for Kim for sharing your wisdom, for Julia for your facilitation, and Davey for your help. We are going to be right back here to continue this conversation in 2 weeks on Wednesday, November 4th at noon. And we will certainly read through the questions that we didn't get to in the chat box and try and incorporate that into our next conversation. We're going to send a follow-up email as well. It will have a link to this recording. If you want to share, we'll have it on our website too, so you can go back and visit and share with others. And you can respond to that email too and let us know if you have thoughts, questions, etc. So we can kind of continue to tailor this and meet your needs. And I also just wanted to share that we are intending to think about if this should be an ongoing conversation and if there should be more of kind of a women's money club that meets on a regular basis to help answer these questions, because I know this is such a huge need and something that we at the Women's Foundation can really help women with. So thank you, everyone. Have a wonderful rest of your day, and we'll talk again soon. Bye-bye.